Good day, everyone, especially to our instructor, Sir Jerome Ramirez. And for today's video, we're going to discuss our topic, which is Chapter 4, the financial analysis. So, first is analysis of financial information. One final step in understanding business finance is the analysis of financial information. The prerequisite to this analysis is knowing and understanding available information and drawing logical conclusions. The steps are: first, the information must be understood by the user. Second, the information must be organized using some financial data statement. And last, the information must be measured. So first is information must be understood by the user. Data can never be analyzed unless it is fully understood. At the same time, financial information must be treated with total honesty, understanding has its context and an understanding of everything that is presented. Number two, information must be organized. Before analysis can be made, information must be sorted out. Supposing a data on profit and loss account for a manufacturing business shows current year data. But if you look back on several years, a different can be done. Number three, information measurement. Once we have understood and reorganized the financial data needed, then measurement can be done using applied common sense and analysis by means of financial ratios. Then finally, the data can be then interpreted. The next one is managerial and financial accounting. So, what is accounting? Accounting is the process of collecting, reporting, and analyzing the costs associated with operating in a business. There are internal and external users of accounting information. External users may include the Bureau of Internal Revenue for tax liability purposes, the Securities and Exchange Commission for annual reporting for shareholders' records, banks for evaluation of financial standing for loan applications, and private individuals for investment interest. This system is called financial accounting. The next one is internal users may require different types of data and reports generated by the accounting staff of the firm's accountant. These data guide the organization, particularly the finance executive, to decide on some project to undertake, financial planning, and funding. This type is called managerial accounting. Finance is the process of obtaining and employing assets that allow the firm to continue and expand operations, while accounting is a system that communicates important information about the company's operations.
The balance sheet as a summary of amounts of kind of asset that the firm possesses as well of the claim made against of this asset by inventors and creditors include the following accounts concept. The total of the firms of the asset must be equal of the value of the claims against the firm. Currently, asset is one that converted into cash in the normal operation of the firm with 1 year. The fixed asset is a permanent asset that will not normally be converted cash on the balance sheet, fixed asset, and shown of the historical cost, which the amount of actually paid of the asset. The market value of the asset is the price of the asset of command in the market and the replacement cost in the price that would be required to replace the asset it be had acquired today. The values of assets shown of the financial reports and books of the company of the book value may difference from the market of the asset. Asset of the has been become absolute typically have market value below the book of values, while the opposite of condition hold asset such as land and have appreciated in the value. Current liabilities of those firm reasonably expect to pay within the next year. Account payable and obligation that is a firm of the good it has received from the others. Notes payable and short term of debit of the firm must be pay off within the next year. Actually, are the debit of the owns of the payment is not of the been made such as the salaries owned into the employees. Taxes payable are tax of the owned but they have not been yet paid. Liabilities are continuing obligation that will be completely repaid during the next year, such as long debit as the long-term leases. The common stock account reflects a capital that were contributed by the equity holders of the firm. The retained earnings account the shown of amount of earning the firm has accumulated since its inception, retaining earning and net income that the firm has not paid out on dividend it is shareholders. The statement of the firm changes in financial condition or the sources of uses of fund statement which identifies the origin and utilization of fund acquired considered of the following principles. For any firms of the essential, this is source of the uses of the fund. A sources of fund, an increase of liability account, a zero increase of the net worth account, zero decrease in the asset account, uses of funds, decrease in liabilities amount, decrease in the net worth accounts.
Vertical and horizontal analysis of financial statements. Vertical analysis is the process of analyzing the entries on a financial statement in relation to the industry standard. Ratio analysis is descriptive. It describes the situation that exists. It is not prescriptive. It does not tell the manager what to do. However, if the manager has the ability to look past the simple calculation of numbers and begin to see the trends, decision making becomes easier. Ruth Rock Enterprise Income Statement in millions of pesos. Net sales 16,786, 100%. Cost of goods sold 1,199.57, 71.5%. Gross profit on sales 479.1, 28.5%. Selling, general and administrative costs 174.8, 10.4%. Earnings before interest and taxes 304.3, 11.1%. Interest income 3.2, 0.2%. Interest expenses 6.9, 0.4%. Earnings before income taxes 300.6, 17.9%. Provision for income taxes 91.5, 5.5%. Net earnings 209.1, 12.55%. Horizontal analysis allows us to analyze changes over time, but in order to do, needing two periods of data. Since a comparison between current and previous data, the formula for a horizontal analysis is value in new time period minus value in old time period over value in old time period times 100 equals percent change. Horizontal analysis compares the change in each line item on a statement with the same item in a previous statement. Unlike vertical analysis, the percentages does not illustrate the relative importance of any given life item. Root Rock Enterprise income statement in millions of pesos. Net sales 1,678.6, 1,776.4, 5.8%. Cost of goods sold 1,199.5, 1,226.8, 2.3%. Gross profit on sales 479.1, 549.6, 14.7%. Selling, general and administrative costs, 174.8, 174.7, negative 0.1%. Earnings before interest and taxes, 304.3, 379.9, 23.2%. Interest income, 3.2, 6.7, 109.4%. Interest expense, 6.9, 6.8, negative 1.4%. Earnings before income tax, 300.6, 374.8, 24.7%. Provision for income taxes, 91.5, 118.9, 29.9%. Net earnings, 209.1, 255.9, 22.4%. Financial ratios. These are indices used in expressing financial data in such a way that it can be compared and trends identified, and thus questions can be raised. Ratios should be used to build up and summarize the evidence available and to create a picture from which is not conclusions, but better questions can be drawn. They have a role to play in summarizing financial data so as to produce the right questions. But it must always be remembered that they do not in themselves in any way provide answers. Primary ratios considers profit or return level of the business entity, normally for the year, in relation to the capital employed or invested or net assets during the same period. Secondary ratios are further investigation ratio. These are ratios concerned with profitability profit in relation to sales, and the other is with activity sales in relation to capital employed or net assets. Tertiary ratios evaluate profitability of the business and analysis of activity. Profitability ratio can be assessed from the point of view of gross profit or contribution to sales as a percentage. Activity or use assets ratio is examination of activity by comparing sales separately with fixed assets and working capital. This will reveal how many times we are turning over our investment in these two areas in relation to sales for the period or for the year. Financial status ratio are those that help analyze a business financial standing in terms of its ability to pay liabilities and settle obligations. Liquidity ratio is the relationship of current assets to current liabilities. Solvency ratio calculate the ability of the business to meet the interest due from the profits available. Investment ratio are intended to give investors financial position of the business and the investment capital. Price earning ratio expresses the number of times the price of the share exceeds the earning per share. Dividend yields reveals rewards to investors the dividends paid to them with the market price of the shares. Dividend covers uncovers generosity of the business in terms of determining the proportion of the profits distributed to investors. The higher the dividend cover, the greater the retention, the lower the distribution.
Commonly calculated ratios. Liquidity ratios. Liquidity is the ability of assets to be converted quickly into cash. It is assumed that firm's inventory will be converted to cash during the course of a year so that the receipts from the inventory can be used to service the current debt. Commonly used ratios to liquidity are current ratio and quick ratio. The current ratio is the ratio of current assets to current liabilities. Current ratio is equal to current assets divide current liabilities. The quick ratio is the ratio of current assets excluding inventory divided by the current liabilities. Quick ratio is equal to current assets minus inventory divide current liabilities. Activity ratios are related to operations and operating efficiency because they measure how quickly the firm is converting assets into cash. The goal of the firm is maximize revenue and minimize cost, and since there is a cost to carrying inventory and accounts receivable, the efficient firm will want to minimize the time that they hold on cash assets. Inventory turnover measures how many times per period, usually a year, the firm sells through its inventory. To be more accurate, the firm should use an average inventory rather than the year-ending inventory. Inventory turnover is equal to sales divide average inventory. Days of sales in inventory equals to inventory divide sales per day. Some business may have longer days for stocks to stay before they can be sold out. Others maybe have quicker or shorter days for inventory turnover. Average collection period is also called days of sales outstanding. The average collection period describes the average time it takes to collect accounts. Average collection period is equals to receivables divided by sales per day. Inventory conversion cycle combines the days of sales in inventory and days of sales in accounts receivable. It gives the company an idea as to how long it takes to convert inventory to accounts receivables and subsequently into cash. Inventory conversion cycle is equal to days of inventory plus days of sales outstanding. Asset turnover is concerned with the efficiency of assets. The goal is not well through the fixed asset, but to maximize the efficiency of those assets. True test of efficiency is not inventory turnover, but how many sales can be generated in the space available. Since sales floor is the mixed assets, the revenue is derived from the efficient utilization of the space. For service firms, fixed assets turnover ratios are better indicator of success. Fixed asset turnover looks at sales in comparison to the long-term assets of the firm, such as land, equipment, and plant. The formula of fixed asset turnover is fixed asset turnover is equal to sales divided by fixed assets. Total assets turnover combines the effects of current asset management, the conversion of inventory and accounts receivable into cash, and fixed asset management. It allows the firm to compare how it is managing each type of asset. If total assets are turning over more slowly than fixed assets, the firm is not aggressively managing the current assets of cash, account receivable, and inventory. Total asset turnover is equal to sales divided by total assets. The leverage ratios. It is the responsibility of the financial manager to determine the level of the debt is appropriate for a firm. Debt or loan has a fixed value. If the company is making regular payments, its principal value decreases over time. If the firm is growing, its value increases, which goes back the stockholders in the form of dividends or reinvested capital. If the firm can earn more than cost of loan interest, it may be worth securing additional loan or leveraging the firm. Debt to equity ratio shows the relationship between debt and equity, where debt to equity ratio is equal to debt divided by equity. The higher the debt of a firm is relationship to its equity, the more leverage it is and more risk it has. Another way of looking at the financing choices of the company is to compare the debt burden to the value of the total assets, where debt ratio is equal to debt divided by total assets. For firms where investment in long-term assets is high, leverage can be higher. Like manufacturing industry, for service firms with little capital investment, level can be lower. Time interest earned ratio determines if the firm is capable of serving the interest they have or for dips and gives idea of whether additional interest expense could be added. Debt obliges the firm to make specified payments of both principal and interest at regular intervals. Time as times interest earned ratio is equal to operating income times earnings before interest and taxes divided by interest. Profitability ratios. Since the goal of most companies is to earn a profit, these ratios are the most important to financial managers. Gross profit margin profitability is the broadest measure of the firm's profit level. Gross profit margin is equal to revenues, cost of goods sold divided by sales. Gross margin measure profit before operating expenses, interest, and taxes are subtracted. Supposing April Research Company has this income statement. April Research Company income statement in millions of pesos. Revenue is 2.0. Cost of revenue, research and development is 94.2. Gross profit is 92.2. Sales general administrative expenses is 14.7. Gain from operations is 106.9. Interest income is 2.6. Interest expense is 3.2. And the net profit is 107.5. Operating profit margin examines the income of the company before taking into account the interest and taxes. Operating profit margin is equal to earnings before interest and taxes divided by sales. The difference between gross margin and operating margin is that the latter takes into account overhead cost, not just direct cost of goods sold. Net profit margin demonstrates a better assessment of a firm's profitability, particularly for a company who does owe interest and taxes. This is the bottom line. The net profit margin is the most often used measure of a firm's profitability. Net profit margin is equal to net profit times earnings after interest and taxes divided by sales. Return on asset determines profitability in relations to asset management. Return on asset is equal to net profit times earnings after interest and taxes divided by total assets.